Declining balance depreciation method. This is one of the historical depreciation methods. However, it is used currently by the IRS. The recent tax depreciation table is developed based on the declining balance, 200% declining balance. So understanding this would be very helpful to understand the table as well. As you can see, this simple example, you acquire a piece of equipment for $60,000. The price, shipping, everything costs $60,000. It has a market value of $12,000 at the end of year 14, and going to use 200% declining balance method. So let me show you how to calculate all of this here, all the depreciation here. If you use the textbook formulas, it's going to be complicated. I suggest you can still use those examples, but solve using the Microsoft Excel, the process I will show here. Don't use that equation, it's very complicated. So I have extracted all these values from that. So we're going to first create the period, as we do for any engineering economic analysis. We'll go up to 14, year 14, and then we'll calculate the depreciation. I'll just type it short by double declining balance method. First year you don't claim anything, and then second year I need the book values to use that Excel trick without using the formula in the book. I need the book value of the equipment. So the first year it has $60,000 book value. So 200% decline, the way the formula works, basically you simply that book value divide by the number of years that you're going to use that machine. That's 14. I'm going to freeze that because I'll be using for all of these periods, all of these years, times that it is declining by 200%. I'll freeze that as well. So that will be my depreciation for all of this. Now the book value for year 2 would be this minus whatever it depreciated. So then I can copy this all the way down. So that's the total depreciation charges using that declining balance, in this case double declining balance, 200%. As you can see, it is decreasing by some percent, basically for 200 divided by 14, which is 200% divided by 14, which is 1 by 7. So you're multiplying this by 1 by 7, so it will never go to 0. So if you sum all of these, the total depreciation charges based on the declining balance, it will never basically go up to that 60,000 which you have spent it for. It will match, it will not match the numbers. So what will going to happen is the way IRS works and the things work is basically because it never goes to 0, you are always losing something. So then it uses the declining balance, then switch over to straight line method, and we'll show you that. Let me first calculate the depreciation for using the straight line method, which you know is very simple. First year is nothing, and the from second year straight line method depreciation is basically that $60,000 minus the end of life market value. I think I'll have to freeze both of them because I'll be using them again and again for all 14 years. Divide by the 14 years. I'll freeze that again. So copy that all the way down. So that is the straight line depreciation. So each year I'm claiming this much. So the way this declining balance work is basically it switch over to whichever one gives you the best tax deduction or depreciation. As you can see here on this row, year 7, you're getting by double declining balance this about $3,400, less than $3,400, but in straight line method you are getting more than $3,400. So basically you can develop a function. Simply we'll say depreciation charge, whatever we charge them, you can simply type a function called max, and that will, you can basically pick the max between these two numbers, the double declining and straight line. So then as you can see here, starting from year 7, it's going to use that straight line method. So you can claim more depreciation earlier. So you can reduce your taxes earlier. Don't have to pay more taxes. So this is now the actual blue book value now. Sorry, not blue book value. The actual book value. Now this book value is only for that declining balance calculation. This is not the book value because we are not claiming the declining balance starting from year 7. We are claiming the straight line method from year 7. So the book value now would be basically that $60,000 starting from year 0, and then it's going to be this book value minus whatever we charge the depreciations, and you copy all the way down. As you can see, it is start to go negative. So you can't claim more depreciation than 60,000. Let me calculate the total depreciation by the straight line switch over to the double decline switch over to straight line. Let's see what's the total. So if we sum that, that's the depreciation we have charged. You see that's more than 60,000. We didn't even spend 60,000 for that. So definitely not right thing to do. We did not spend that much, but we are claiming this much for tax purposes, which is wrong. So delete this, and then as you can see in year 12 we have this much value left. So in year 13 we'll basically only claim this much depreciation, and we're not going to claim anything there. It's going to be 0, 0 there. Now you will see that this is exactly 60,000 whatever we spend it for. Now what's going to happen at end of life useful life market value at year 14, right here you're going to be paying that $12,000 taxes when you are going to sell that equipment. That's a different calculation. However, to summarize this method, the declining balance switch over to a straight line. So first you calculate the declining balance the way I have shown here, not using the formula in the book. It's going to be really complicated doing that. So use Excel to do that. And then you also develop the straight line method depreciation, which we have shown in the previous video also here. And then you get the maximum out of these two for the depreciation charges. Then you calculate the book value, and then the book value. When you see start to go negative, then you see the last number, and then that's the $3,200 left for year 1200, and you can claim everything in year 13 that, and that way basically it matches everything that you have paid or used for that piece of equipment. So I think that's all.